In accordance with IFRS 3.46, an acquirer has a period of time referred to as the measurement period to finalize the accounting for a business combination. Explain the requirement of measurement period adjustment. Answer: if the initial accounting for a business combination is incomplete by the end of the reporting period in which the combination occurs, the acquirer shall report in its financial statement provisional amounts for the items for which the accounting is incomplete. During the measurement period, the acquirer shall retrospectively adjust the provisional amount recognized as the acquisition to reflect new information obtained about facts and circumstances that existed as of the acquisition date, and if known, would have affected the measurement of the amount recognized as of that date. During the measurement period, the acquirer shall also recognize additional assets or liabilities if new information is obtained about facts and circumstances that created or that existed as of the acquisition date, and if known, would have resulted in the recognition of those assets and liabilities as of that date. The measurement period ends as soon as the acquirer receives the information it was seeking about facts and circumstances that existed as of the acquisition date, or learns that more information is obtainable. However, the measurement period shall not exceed 1 year from the acquisition date. Question 2. Explain how and when a contingent consideration used in business combinations can be accounted for as equity or liability. A contingent consideration arrangement that is required to be settled in cash or other assets should be classified as a liability. There may be situations where a contingent consideration arrangement is settled with the entity's own equity shares, yet the arrangement is accounted for as a liability. Example, a fixed amount to be paid in a variable amount of shares. The classification of contingent consideration under IFRS is based primarily on the following criteria. Contingent consideration arrangements that will be settled in a fixed number of the issuer's equity instruments will be classified as equity. Otherwise, if the arrangement results in the delivery of a variable number of shares, the arrangement will be classified as a liability under IAS 32.16b. For arrangements that include more than one performance target, it must be determined whether the unit of account is the overall contract or separate contracts for each performance target within the overall contract. To be assessed as separate contracts, those performance targets must be readily separable and independent of each other and relate to different risk exposures in accordance with IFRS 9. If separable, these contracts may then individually result in the delivery of a fixed number of shares and as a result be classified as equity. Otherwise, the arrangements must be viewed as one contract that results in the delivery of a variable number of shares and would be classified as a liability because the number of shares that will be delivered depends upon which target performance is met. 3. Third of the criteria, equity classification is precluded for contingent consideration arrangements that meet the definition of a derivative if the arrangement has a settlement choice. Example, net share or net cash, even if it is the issuer's exclusive choice. Question 3. Describe what factors should be considered in determining whether potential voting rights are substantive. So this is the answer. exercise price, not at a level that prevents or deters exercise. Timing of exercisability, exercisable in time to affect key decisions. Intent to exercise, apparent expectations, motives and reasons are part of the assessment. Financial ability, relevant to evaluation of investors' practical ability to exercise. Lastly, operational barriers or incentives. Relevant if investor does not have practical ability to exercise, for example, due to specialist knowledge or expertise of current owners. Question 4. Explain protective rights, providing for instances where voting or contractual rights could be regarded as protective. Protective rights are rights designed to protect the interest of the party holding those rights without giving that party power over the entity to which those rights relate. Because protective rights are designed to protect the interest of their holder without giving that party power over the investee to which those rights relate. An investor that holds only protective rights cannot have power or prevent another party from having power over an investee. Some examples of the types of rights that might be protective include: 1. Rights held by a lender that can be used to prevent borrower from undertaking activities that could significantly change the credit risk of the borrower. 2. Rights held by a lender to seize assets in the event of default. 3. The rights of a party holding a non-controlling interest in an investee to approve capital expenditure above set limits or to approve the issue of equity or debt instruments. 4. Blocking rights over matters such as taking foreign takeovers or changes to an investee's founding charter held by a government or founding party via a golden share. 5. Rights held by a franchisor to protect the franchise brand against the adverse actions by a franchisee. Now, question 5. Explain how the following situation could or should be dealt with when preparing group financial statements. A. Group members with non-coterminous reporting dates. Then B. Group members with different accounting policies. Group members with non-coterminous reporting dates. Some companies in the group may have differing accounting dates. In practice, such companies will often prepare financial statements up to the group accounting date for consolidation purposes. For the purpose of consolidation, IFRS 10 states that where the reporting date for a parent is different from that of the subsidiary should prepare additional financial information as of the same date as the financial statements of the parent unless it is impracticable to do so. If it is impracticable to do so, IFRS 10 allows use of subsidiary financial statements made up to a date of not more than 3 months earlier or later than the parent's reporting date, with due adjustments for significant transactions or other events between the dates. B. If a member of a group uses accounting policies other than those adopted in the consolidated financial statements for like transactions and events in similar circumstances, appropriate adjustments are made to that group's members' financial statements in preparing the consolidated financial statement to ensure conformity with the group's accounting policies. 6. Explain the deferred tax implications of the following Business combination adjustments. A. Intangible assets of the acquiree. And B. Adjustments for intragroup profits. Answer. A. Intangible assets of the acquiree. IFRS 3 requires intangible assets acquired in a business combination to be recognized at their fair value in the consolidated statement of financial position. Tax rules on intangible assets vary from jurisdiction to jurisdiction. Understanding these rules is necessary to identify the tax basis of intangible assets and, accordingly, any temporary difference that may arise. For example, in certain jurisdictions, tax is calculated using the separate financial statements of the members of the group and not the consolidated accounts. Hence, if an asset arises only on consolidation, its tax base will be nil. This is because the income earned while the asset is used will be taxable and there will be no tax deductions available against that income from the use of the asset. Equally, if such an asset were sold, there would be usually no tax deduction on disposal. This results in a temporary difference equal to the carrying value of the asset on initial recognition in the consolidated accounts. As the intangible asset is amortized, the temporary difference will decrease. The reduction in the deferred tax liability is recognized in profit or loss. The recognition of this deferred tax credit to profit or loss reduces the impact of the amortization of the intangible assets of profits for the year. B. Adjustments for intragroup profits. IAS 12 requires the recognition of deferred tax on all unrealized intragroup profits. Where, for example, a company in the group has sold inventory to another group company, and this inventory remains unsold at the year end, the unrealized profits on this intragroup transaction should be eliminated on consolidation. Deferred tax then has to be provided on the difference between the carrying value of that inventory, which will be after elimination of the intragroup profit, and its tax base, which will be the cost of the inventory in the acquiring company. That is before elimination of the intragroup profits. Where the two group companies pay tax at different rates, the acquiring company's tax rate should be applied to this temporary difference to calculate the deferred tax balance. This is because the tax rate and any tax base of the asset must be consistent. The tax base is the deduction that will be available in the future. This will accrue to the acquiring company. Accordingly, the appropriate and applicable tax rate is also that of the acquiring company. Question 7. Explain the consolidation implication of a change in group structure that does not result in loss of control. Answer. The following accounting implications should be noted when an NCI, that's a non-controlling interest, in a subsidiary changes, but the same parent retains control. 1. No gain or loss is recognized when the parent sells shares, so increasing NCI. NCI represents non-controlling interest. Then 2. A parent's purchase of additional shares in the subsidiary, so reducing non-controlling interest, thus NCI does not result in additional goodwill or other adjustments to the initial accounting for the business combination. And 3. In both situations, the carrying amount of the parent's entity a non-controlling interest share of equity is adjusted to reflect changes in their relative ownership interest in the subsidiary. Any difference between the amount of NCI adjustment and the fair value of the consideration received or paid is recognized in equity attributed to the parent. Question 8. Explain the definition of investment entity and briefly discuss the investment entity exception under IFRS 10 consolidated financial statements. Answer. So what is an investment entity? An investment entity is an entity that 1. Obtains funds from one or more investors for the purpose of providing those investors or investor with investment management services. Investment services condition into brackets. Or 2. Commits to its investors or investor that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. Brackets business purpose condition. And 3. Measures and evaluates the performance of substantially all of its investments on a fair value basis. That's fair value condition. Except for subsidiaries required to be consolidated under IFRS 10, an investment entity shall not consolidate its subsidiaries or apply IFRS 3 when it obtains control of another entity. Instead, subsidiaries held as investments are measured at fair value through profit and loss in accordance with IFRS 9. This accounting is mandatory, not optional. Voluntary consolidated financial statements that state compliance with IFRS are not permitted. IFRS 3 does not apply to the obtaining of control over an exempt subsidiary. An investment entity is not required to produce consolidated financial statements if all of its subsidiaries are required to be measured at fair value through profit or loss. Consolidation exception also applies to controlling interests in another investment entity. An investment entity is still required to consolidate subsidiaries that are not themselves investment entities called service subsidiaries and whose main purpose and activities are providing services that relate to its investment activities. Question 9. Explain in what ways an investor may lose control over an investee, indicating how such accounting events should be dealt in the consolidated financial statement. Answer. Again, explain in what ways an investor may lose control over an investee, indicating how such accounting events should be dealt with in the consolidated financial statements. Events that may result in the consolidation of a subsidiary that is a business include the following. 1. A parent sells all or part of its ownership interest in its subsidiary, thereby losing its controlling financial interest in its subsidiary. 2. A contractual agreement that gave control of the subsidiary to the parent expires. 3. The subsidiary issues shares, thereby reducing the parent's ownership interest in the subsidiary so that the parent no longer has a controlling financial interest in the subsidiary. 4. The subsidiary becomes subject to the control of a government, court, administrator, or regulator. If a parent loses control of a subsidiary that is a business through means other than a non-reciprocal transfer to owners, it must 1. Derecognize the assets, including an appropriate allocation of goodwill and liabilities of the subsidiary at their carrying amount at the date control is lost. Then 2. Derecognize the carrying amount of any non-controlling interest at the date control is lost, including any components of accumulated other comprehensive income attributable to it. Then 3. Recognize the fair value of the proceeds from the transaction, event, or circumstances that resulted in the loss of control. 4. Recognize any non-controlling investment retained in the former subsidiary at its fair value at the date control is lost. 5. Reclassify to income, as profit or loss, or transfers directly to retained earnings if required. In accordance with other IFRS, the amounts recognized in other comprehensive income in relation to the subsidiary. 6. Recognize any resulting difference as a gain or loss in income, profit or loss attributable to the parent. The gain or loss is calculated as the difference between, that is the aggregate of the fair value of the consideration transferred. Secondly, the fair value of any retained non-controlling investment in the former subsidiary on the date the subsidiary is deconsolidated. 3. The carrying amount of any controlling interest in the former subsidiary, including any accumulated other comprehensive income or loss attributable to the NCI on the date the subsidiary is deconsolidated. Then finally, the carrying amount of the former subsidiary's net assets. Question 10. Briefly explain how an acquirer may obtain control without transferring consideration through any of the following ways. A. The acquirer repurchases a sufficient number of its own shares for an existing investor, herein the acquirer to obtain control. Then B. Minority veto rights lapse that previously kept the acquirer from controlling an acquiree in which the acquirer held the majority voting rights. And C. A combination by contract alone. Consolidation implication. In a business combination achieved without the transfer of consideration, goodwill is determined by using the acquisition date, fair value of the acquirer's interest in the acquiree, measured using a valuation technique other than the acquisition date fair value of the consideration transferred. The acquirer measures the fair value of its interest in the acquiree using one or more valuation techniques that are appropriate in the circumstances and for which sufficient data is available. If more than one valuation technique is used, the acquirer should evaluate the results of the techniques, considering the relevance and reliability of the inputs used and the extent of the available data.